Okay, so you're chasing yield in this market. And let's face it, who isn't these days?
Right.
You've probably heard about private funds, private equity, private credit, maybe illiquid real estate.
Yeah, the stuff that promises those sweet, steady returns.
Hmm.
The kind of alpha the big university endowments always seem to get.
Exactly. It's that institutional playbook, but now it's being pitched more broadly. But here's the question we're tackling in this deep dive. What actually happens when things turn and you need to get your money out?
Mm-hmm. You might think liquidity is just part of the deal, but for potentially millions of retirement savers now getting exposure, that assumption, it's starting to look pretty dangerous.
So our mission today is really to unpack this. There was a stark warning recently from Jason Zweig in the Wall Street Journal.
A really good piece.
And it applies not just to, the billion-dollar managers, but potentially to anyone with a 401k or IRA that's starting to dabble in these assets. We're talking about the liquidity illusion.
That's the term.
And here's the setup, really. If small local pension funds are struggling to get their cash back, what does that mean for an individual investor?
We've looked at a bunch of sources detailing these recent struggles, especially with modest retirement systems. And yeah, they expose this critical risk. The bottom line is pretty simple, isn't it? Liquidity feels abundant.
Until the moment you actually need it.
Exactly. Then it vanishes.
Let's make this concrete. Let's talk about specific cases, because this is where it gets really compelling. We're not talking giant funds here.
No, these are managers handling retirements for everyday people. Think firefighters, teachers, city workers.
Right, like the Howard County Retirement Plan in Kokomo, Indiana. Pretty modest, maybe $300 million under management. Or the San Bernardino City Employees Retirement System in California, maybe closer to $1 billion.
And these funds, they have really strict duties. They're not trying to hit home runs. They need to make sure those monthly pension checks go out reliably.
So they put some money, maybe 15, 20% of their assets, into private funds. Some big names too, right? Like Blackstone or Apollo Credit Funds.
Yes, exactly. Standard practice, diversifying their portfolio.
And then the need hit. Simple, immediate. It's 2022, 2023, interest rates are rising, inflation's up.
They needed cash, either for immediate pension payouts or often just to rebalance the portfolio. Public markets drop, your private allocation suddenly looks too big. You need to sell some privates to get back in line.
Makes sense. So they put in their redemption notices,
Yeah.
expecting what, 30 days, 90 days maybe?
That's what the marketing materials often suggest, especially for these sort of semi-liquid type funds. A quarterly redemption, maybe a short notice period.
But hang on, these are professionals running these pensions. Why did they get caught out? You'd think these huge general partners, the GPs running the funds, would have this figured out. Why was it so hard to get the cash?
Well, this is where it gets interesting. That expected quick exit, it turned into this multi-year saga. Instead of 90 days, we saw delays stretching from 6 months all the way up to 18 months in some cases.
Well, 18 months.
Yeah. And the GPs gave various reasons. Deal flow slowed down. They were waiting for capital calls to close, or maybe just holding on to cash to invest in new deals at better prices.
And the main tool they used to block the exits was invoking gates, right? This is really key for listeners to grasp. How do these gates actually work?
Think of it like a bottleneck, or maybe a bouncer at a club door, but just for money leaving the fund. A private fund might say, okay, only 10%, maybe 25% of the fund's total value, the net asset value, or NAV, can be redeemed in any given quarter.
Okay.
So if redemption requests pile up and exceed that limit, which they definitely did in 2023, well, too bad. Your request gets pushed to the next quarter. Or maybe you only get a small part of what you asked for. It creates this massive backlog.
So these smaller pension funds needing, say, $20 million right now, they find themselves stuck, waiting maybe 6 quarters, just sitting in line behind much bigger investors who might have priority.
That's exactly it. And the pain wasn't just the waiting. When they finally got some money out, often in pieces.
They didn't get the full value.
No. They didn't get the official reported NAV. They got hit with these significant haircuts, discounts of 10%, 20%, sometimes even 30% below that official valuation.
That's devastating, especially when you're managing money for teachers and firefighters. The source material mentioned one case, a $20 million stake.
Yeah, I remember that one.
That eventually got redeemed for only $14 million. That's a $6 million loss, basically just because they needed the money out sooner rather than later.
$6 million. For a small town, that's a lot. That's park maintenance, maybe new safety gear for the fire department. It's real money.
Which explains why one of the CIOs from these funds said something really telling.
Yeah, that quote. We thought we were diversified, but liquidity is the great illusion in privates. It's there until you need it.
Hits the nail on the head.
It really does. And it highlights the power dynamic, doesn't it? If you're a giant like CalSTRS putting in billions, you can negotiate special terms, side letters, better liquidity rights.
But if you're a $300 million county fund,
You're basically a small fish. You get the standard terms, and you wait and assign when things get tight.
okay, let's zoom out from Kokomo, because this isn't just a one-off problem for a couple of small towns, right? This is a symptom of something bigger.
Absolutely. The private markets are huge now. U.S. assets alone, over $10 trillion.
And what worries me personally is how aggressively these things are pushing into retail retirement accounts.
Yes, that's a major trend. These retail-focused vehicles, things like interval funds, tender offer funds, they've just exploded.
Yeah.
We're talking over $200 billion in assets now.
And they're marketed straight to people with 401k IRAs. Sometimes they're tucked inside target date funds.
Where savers might have, say, 5% or even up to 20% in these alternatives, and they might not even fully grasp the liquidity risk they're taking on.
And the data backs this up, doesn't it? This bottleneck is getting worse.
Oh yeah, the numbers from 2023 were stark. Redemption requests in private funds spiked. Some funds saw increases of 40%, others up to 150%. Huge jumps.
But the funds couldn't meet the demand.
Exactly. The fulfillment rates, the amount they actually paid out, dropped significantly, often below 60%. The cash just wasn't there or wasn't being made available fast enough.
So if the fund itself won't let you out easily, the only other option is the secondary market, selling your stake to someone else.
Right. And that market is booming, maybe $150 billion in deals expected for 2024. But here's the catch. Those deals, they're happening at painful discounts, average discounts of 15 to 20% below NAV.
So you're paying a hefty price just to get access to your own money.
Fundamentally, yes, a very heavy tax for liquidity.
So let's bring this right down to the individual listener. Someone listening now, maybe they have a small slice of their 401k in one of these. What are the specific threats?
I think we could break it down into like a triple threat to your retirement security. First, the most obvious one, liquidity traps.
Meaning your money is just stuck.
Right. Let's say something unexpected happens. You lose your job, maybe face a big medical bill, you need cash. If part of your cushion is in that private allocation,
That 5 or 10%.
it could be locked up for 6 months, 12 months, maybe even 24 months in a bad scenario. So what do? You're forced into bad choices.
Like taking on high-interest credit card debt.
Or, maybe worse, selling your public stocks, the ones you can sell, potentially at a loss, just to cover the immediate need. Because you can't touch the private stuff you thought was available.
Okay, that's threat number one. What's the second?
The second is particularly nasty for people near or just starting retirement. It's sequence of returns risk. And illiquidity makes it so much worse.
Explain that connection. How does being locked up amplify sequence risk?
Okay, sequence risk means the order of your investment returns matters hugely, especially right after you retire. So imagine you retire right into a market slump. Your stocks drop 20%. Normally, you might rebalance, maybe sell some bonds or other assets to buy more stocks while they're cheap.
Or just sell proportionally across your portfolio for income.
Exactly. But if your private fund allocation is frozen, gated,
Mm-hmm.
you can't sell those assets.
Yeah.
You can't use them to rebalance or to generate income. So you're forced to sell more of your public assets, the stocks and bonds that are already down.
So you're selling low in the public market.
Well, the frozen private assets just sit there, unable to participate in any potential recovery. That illiquidity effectively locks in those early losses. It stops you from managing your withdrawals smartly, and it can permanently scar your retirement portfolio.
That's a scary thought. And the third threat ties back to those discounts, the haircuts.
Yes, the third threat is valuation opacity.
Meaning you don't really know what it's worth.
Pretty much.
Yeah.
Unlike a stock trading every second, a private asset's value is marked to model. The fund manager decides the value, the NAV, using their own internal models.
Okay.
And often during market stress, that official NAV looks suspiciously stable. It doesn't drop like public markets because there's no real-time trading to prove its value.
Until someone tries to sell.
Exactly. When that small pension fund finally gets out, but at a 25% discount, it basically reveals the truth. That official NAV they'd been reporting, it was likely inflated all along. You only find out you really had $14 million, not the $20 million on paper, when you actually managed to get the cash.
Okay, so we've painted a pretty concerning picture. But the good news is, knowing this before a crisis is useful. So for the listener, what are the practical, actionable things they can do now to manage this risk?
Right, let's talk solutions. Step one is pretty straightforward. Cap your exposure.
Set a limit.
Yeah. Based on what we're seeing with these pensions, a sensible cap on total private fund exposure seems to be around 5%, maybe 10% absolute max your overall portfolio. Go much higher, and you're really amplifying that systemic liquidity risk.
Makes sense. What's next? Look at the fine print.
Definitely. Prioritize structure. Not all alternative funds are built the same. You absolutely have to dig into the exit rules.
What should people look for?
Ideally, you want funds with so-called evergreen structures. These are usually open-ended funds aiming for some liquidity, like offering quarterly redemptions. Now, they still have gates, remember?
Right, the gates don't disappear.
No. But it's generally better than the traditional closed-end 10-year lockup fund, where your money is basically gone for a decade. Unless you are absolutely certain you won't need that capital for 10-plus years, evergreen is probably the way to go within privates.
And if someone wants that private market type of exposure, but without the gate risk entirely?
Then you look towards liquid alternatives that are listed on exchanges.
Plug what?
Things like business development companies, BDCs. These are publicly traded companies investing mostly in private debt. They give you that private credit exposure, but you can buy and sell shares like a stock. Or look at listed private equity ETFs. The underlying holdings are different, of course, but the key point is tradability. You bypass the fund level gate problem.
Okay, useful options. And my favorite piece of advice here is proactive, the stress test.
Yes. This is crucial. Don't just look at the fancy return projections from the fund manager. Sit down, maybe with your advisor, and model it out. What happens if 20% of your assets, or maybe even 50% of your alternative allocation, becomes completely frozen for, say, 6 months or 12 months?
Could you still pay your bills? Would it derail your retirement plan?
Exactly. Testing your personal tolerance for that kind of illiquidity before the market seizes up, that's probably the most important due diligence you can do.
Let's connect this back out again. The struggles in Kokomo and San Bernardino, they're not happening in a vacuum. What are the wider market implications?
Well, the first big one is portfolio contagion.
Contagion, that sounds bad. How does trapped private money hurt the public markets?
Think about it. If big institutions are locked out of their private funds, but they still need cash, maybe to meet daily fund redemptions or mandatory pension payouts, what do they sell?
The stuff they can sell, their public stocks and bonds.
Exactly. They're forced to sell their liquid assets. This creates extra selling pressure in public markets, making downturns worse. Some analysis suggests this dynamic contributed to those 10–15% S&P 500 drops we saw in parts of 2022 and 2023.
So problems in the private space can actually spill over and amplify volatility in the public space. It's all connected.
It really is. More interconnected than people thought. And this hasn't gone unnoticed. It's definitely triggered regulatory scrutiny.
The SEC is paying attention.
Very much so. They're looking hard at these pension issues, and especially at some of the potentially misleading claims about liquidity made to retail investors. The sources suggest we'll likely see a push in 2025 for better disclosures from private funds. Maybe things like mandatory liquidity risk dashboards.
More transparency, basically.
Hopefully. And we're also seeing a big market shift, an innovation push.
Towards what? Hybrid funds?
Yeah, things like semi-liquid credit funds or other structures trying to blend that private asset yield with some level of quarterly liquidity. Could be a good thing, offering a middle ground.
But caveat emptor still applies. Buyer beware.
Absolutely. You have to scrutinize those liquidity features very carefully. Just because a fund offers quarterly redemptions doesn't mean the gates won't slam shut when everyone rushes for the exit at the same time. Hashtag tight outro.
Okay, let's try to synthesize this. The core message seems clear. Those high returns promised by private markets, they often come with some pretty significant handcuffs.
That's a good way to put it.
And the crisis hitting these small-town pension funds isn't just some isolated sob story from Indiana or California. It's more like a canary in the coal mine, a warning for the whole $10 trillion plus private asset world.
I think that's right. And the central warning for every single investor listening is really this. Are you truly diversified if, say, 20% of your portfolio is only really liquid when markets are already doing great?
Good question.
The most crucial due diligence isn't just checking the potential upside. It's testing your exit plan. Figuring out how you'd get your money out before you actually need it, not finding out you can't when the gate's already locked.
A really vital lesson, especially as these assets become more common. Now, for listeners who want to go deeper on this whole topic of risk management, market risk, credit risk, and especially the liquidity risk dynamics we've discussed.
Yeah, the complex ways these things interact.
The kind of factors that lead to these situations, we'd recommend exploring the work of Dr. Professor Yogesh Malhotra. He has research and a podcast series on AI quantum finance ROI success beyond coming crash that touches on these broader risk frameworks.
Yes, understanding that interplay of different risks is really key to navigating what's becoming a more complex financial world.
Absolutely. Okay, that wraps up this deep dive. Go stress test your portfolio.